Yes, very good morning to all. So I just want to convey a lot of news that I have read in the last 1 week. So first news which I have to uh, display to you is the Uniper gas shortage. Uniper is one of the biggest gas supplier in the Germany. So you could see that the Germany's gas fills during the summer historically fills up and goes down in the winter when there is heating demand. So we can able to see that Germany's gas storage refill appears to have stalled because of the reason that Putin closes off the Nord Stream pipeline for the maintenance. He is said to be using that as a weapon for gas, using it as a weapon. Yes. So apart from that, there is some reason to worry that the eurozone is going towards some kind of a recession. So whether Putin will be reopening this gas supplies back to the Europe is a question. So we have to be cautious on that. So some of the people out there are meticulously shorting euros at the higher levels. So the coming week will be very interesting to see how things will turn out. So the next chat we are going to say we have to show to you is that there is a tremendous depreciation of the developed markets currencies like Japanese and euro versus the emerging markets index basket. So if you look at the Japanese yen and the euro, it has lost more than the emerging markets currencies like Chinese yuan, Mexican peso, South African rand, and Turkish lira. Yes. So, of the equally weighted basket, the yuan and peso have lost 3.5% and 3.8% respectively last year, and the South African rand has lost 15.7% and the lira has fallen nearly 50%. The structural imbalance with the euro and the yen are due to the fact that both the EU and Japan being large importers of energy, while the central banks, the ECB and BOJ, Bank of Japan, sorry, respectively continue to aggressively debase the currency with various forms of yield control curve. So the irony is that the world's second and third largest currencies are not in fact emerging markets, but rather developed economies that have a massive shortage of energy and real commodities that cannot be solved with central bank money printer. The currencies are collapsing as a result of this imbalance. So that is the thing. So the combined euro and Japanese yen have lost 19% for the past 1 year, comparing to the emerging markets currencies of 15%. So the third chart we're going to display to you is that we just wanted to show how things are turning around. So most emerging markets were not on a debt binge in recent years. Net new issuance beyond rolling over maturing debt is modest in most cases. Oil exporters in the Middle East like Saudi and other countries like UAE did a lot of issuance, but they have a lot of forex reserves and sky high oil prices. So it is shown by Mr. Robin Brooks. He is a former chief forex strategist in the Goldman Sachs. So this chart shows that you have to see that in the year 2020, MENA countries, MENA means Middle Eastern and North African countries, used to issue a lot of sovereign debt at the time of COVID-19 pandemic, and they have no worry to finance this debt. Basically, uh, Yeah, that's it. That's it. The finance the debt by paying interest rates because of the high oil prices. There have been high oil prices in the economy, or overall the supply shortages and the Russia Ukraine war is taking oil to new highs, and it gives some cushion for the oil exporting countries to finance their sovereign debt interest rates. And this country is essentially having a lot of forex reserves in the coffers. So the fourth chart that Robin Brooks sir has shared is that the import demand in Chile and Colombia has gone through the roof, and we have to see that across the all emerging markets, Chile peso and the Colombian peso have lost more than the other currencies, especially in Chile. You have to see that the copper prices have been going down for the past 2 or 3 months, so we have witnessed that. And there is no secret as to what the underlying vulnerability. There is minimal exports and lot of import demand, so that's what the chart is saying, so which creates the balance of payments crisis and the current account deficit. You have to see the chart. And the fifth chart, this is our country's situation. It is shared by Alizio, one of the best four macro analysts. Yes, India's US dollar forex reserves hit the lowest since 15 months. Yes. So he noted that liquidity shortage will hit all Asian emerging markets. So there is also saying that at this current level of reserves, the reserves will cover less than 10 months of imports for the Indian economy. So we have only $580 billion of reserve, with somewhat that amount has to go to the closure of external debt maturities, short-term debt maturities in external debt. So the USD/INR has lost close to 7% so far this year due to the import of oil and high oil prices, with the dollar peaking to the higher levels.